Think big. Think positive. Never show any sign of weakness. Always go for the throat. Buy low, sell high. Fear, that's the other guy's problem. Nothing you have ever experienced can prepare you for the unbridled carnage you're about to witness. Right. Super Bowl, the World Series, they don't know what pressure is. In this building, it's either kill or be killed. You make no friends in the pits and you take no prisoners. 1 minute, you're up $500,000 in soybeans, and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
Hello and welcome to the StoneX Grains and Oilseeds podcast with Craig Turner. I'm your host, and I'm a grain broker here at StoneX. I deal with corn, soybeans, wheat, that's winter wheat and spring wheat, the canola markets, anything, all the major markets in North America here, primarily through the United States and Canada. All my contact information is in the show notes and the YouTube page. You can always find my webinars at www.grainsandoilseeds.com. It's plural, grainsandoilseeds.com. It'll bring you right to the StoneX page for my webinar series. Or you can go to www.stonex.com/Craig-Turner. Get all my information there too. So let's jump into it here. We're going to go over some of our grain and oilseed markets. I would say just on the macro front, let's take a look here. The stock market hasn't rallied as much as I thought it would be after getting a 50 basis point cut here. But if we take a look at, we are making new highs. So I thought we might be going higher. This chart we're seeing right here, if you're following along on YouTube, the chart here of the E-mini S&P, it's a monthly chart, and it is showing us making new highs. December futures are at 57.80. And we're well above the moving averages now. The chart is bullish, so we'll see. We'll see if we can keep on chugging along here as we go towards the year end. But what's interesting too is with the interest rates coming down, there is a lot of renewed interest in commodity prices. With interest rates coming down, not only is it a little bit of inflationary, with rates coming down, but also could be a demand boost, and commodities tend to benefit from that. So let's just take a look at, we'll start with corn here. I gotta take a look at, what exactly is going on with the corn market. We have been rallying during September, which is odd. That usually doesn't happen. If you look at a monthly chart, we're almost putting in like a doji candle from August, and then a reversal into September. On the monthly chart, corn is reversing. It looks like honestly, as long as we close around here or pretty close to it, it'll be a very strong reversal signal on the monthly chart. October tends to be a bullish month, for neutral to bullish, usually not bearish though. It's usually neutral to bullish. And listen, this is what's happened, and we'll start off with corn and then we'll work our way through wheat, soybeans, and canola. But corn, there's a lot of old crop that had to be priced. And a lot of that old crop got priced in August, and it really drove down the markets, probably more than it deserved to be. If 20% inflation throughout the economy is real, if we had a 2 billion carryout back in 2019 or 2018, we would have been 330 corn all day long back then in August and September. Now, you add 20% onto that, and that's high threes, low fours, depending on if we're at 320 or 340 back then. So the fact that corn is around $4, I don't think should surprise us. What is surprising is we don't have a lot of harvest pressure, but a lot of old crop was moved. A lot of new, there's a lot of old crop was moved. Some of this new crop has been priced. Farmers are probably going to store corn here, and we're below cost of production for a lot of guys. So if they don't have to sell it, they won't. Those who are selling it are buying it back with calls or call spreads. I particularly like collars. If you have to sell corn, or if you're a buyer, you need to buy it this year, I think there are some very interesting strategies on the collar side designed around July for what will be old crop here in a couple of weeks, and then for D25, which will be the new crop in a couple of weeks. So I think especially if you can sell a put below cost of production, and you can buy a call with a reasonable price target. And you may be saying to yourself, what's a reasonable price target now? Used to be lows with a 2 billion carryout, 320, 330, 340, depending on the year, what some of the other markets are doing. Now it looks like lows for 2 billion carryouts around $4, give or take 10 or 15 cents either way. So if that's the case, the old 350 to 420 range we used to trade in for most of the year, and we'd break below 350 on that harvest lows, and we go above 420 when the market really thought there's a chance for us to be under 10% stocks usage. That new range is most likely low fours to low fives. Let's call it a $4 to 530 range here. So it's kind of where I'd be buying my call in July and December, somewhere in the top of that range, and sell into it. So that would be the farmer strategy, and something that I really like doing. If you need some help with that, you want to help, or you want to help me plan, uh, assist you with planning that, let me know. I'll be reaching out to everyone over the next week or two. I think we will see a little bit of harvest pressure here. I mean, we are going to harvest about 50% of corn and soybeans here over the next 2 weeks. So that's in theory that should put a little pressure on the market. Maybe we can use that market to start setting ourselves up for July and December. When I take a look at corn balance sheet here, um, when I take a look at the corn balance sheet, and I'll put this in the show notes for the podcast and in my newsletter. And if you're seeing it on YouTube, you can view this also. But I don't know, 90 million acres and a 182 yield next year keeps us around 2 billion carryout, and we're going to be around a 2 billion now. So it's hard for me. Arlen was saying 91 million acres is a possibility. So the most bearish scenario I can come up with next year is 91 million acres, a 182 yield, and which puts us at a 2.2 billion carryout. And right now we're at a 2.1 billion carryout, and we're in the low fours. So I think a 2.2 billion carryout puts us at four, maybe like a 395 or something like that for a harvest low next year, which means we could definitely still rally if the market thinks we're going to be tight or have any kind of weather problems. I mean, if we have 90 million acres and a 182 yield, we use as much as we produce. If we have 90 million acres and let's say 80 yield, which would still be great. Now we're below 2 billion again. Um, 90 million acres and a 178. And we don't even have to have a 178 when it's all said and done. The market has to worry about it because it's dry. We don't get rain for, it's hot and dry, or we don't get a whole lot of rain in the off season or whatever it may be. At that point, 178, we're at a 1.7 billion. What's really interesting about corn is in years where we're below cost of production, this far below cost of production, especially when you can consider land that is rented and some of the high rents you see out there. I mean, we can see 88 to 89 million acres next year. I know I've said this before, but it's something everyone needs to realize, because if we have 88 to 89 million acres and the market just even thinks there could be a 178, we're challenged. Now we're probably through 525, 530 as the market needs to know if they need to be concerned about yields in the mid 170s. We had a great year this year. Yield's going to probably be around 183 or 182. It's going to be a huge record. But things are already kind of dry. We're going to have a mild La Nina. We've got issues in South America. It's rare to get garden-like, or it's rare to get these very high trend line yields 2 years in a row, especially lately with everything going on with the weather. So I don't think you can just pencil in a 182 right off the bat. We will have weather scares during the year. Now, if the weather scare is just what it is, a scare, then yeah, you go up to $5 eventually at some point, and you sell into it. And if you have these calls, even better, because in the odd, in the and it happens. I mean, we definitely will have production issues every once in a while where ending stocks are going to be below 1.5, so you have to price ration exports. And in order to price that ration exports, prices have to go much higher, $6, $7. Now that's not usually you kind of hit, just like in 2015 through 2019, you'd hit that $4, 420 mark for a little while and then come back down. Um, if it's a year like that next year for 2025, you get $5, 510, 520, and then come right down. So that's kind of the outlook we have here with corn. This looks more like bottoming action to me on the corn market. I'm a lot more bullish between now and June. I'm a lot more bullish than bearish on corn here, and it's really just playing the odds and playing the numbers. So if you're a spec trader, If you're a buyer of corn, you buy the physical, or you're a farmer, there are ways to. I think there's some very interesting ways to set yourself up here. And if I haven't already reached out to you and talked to you, please contact me and we'll go over those things. On the soybean, so I'm just going to bring up when you take a look at a monthly chart of corn, you can look for yourself. Take a look at a monthly chart of corn, and if we take a look at the monthly lows, we're 320 kind of area between, let's say, 2000 end of 2014 through 2019, 2020, with those high water marks being rarely getting above 450. I mean, honestly, rarely getting above like 435. And if you just add 20% to these things, we have this kind of 390, 395 market to probably around 525, 530 area. I think that's a good place to start for price ranges this year. All right, so that is corn. Let's talk about wheat here. I'm also bullish the wheat market. I'm going to bring up my monthly wheat chart here. Look at a continuous wheat monthly chart. It's the same deal. When I take a look at this and we go back to, let's say, 2016 was a pretty bad year for wheat. I want to say we had the billion carryout and the 50% stock to usage back then. So that was brutal, no doubt about it. And then and our rallies we would get in Chicago, we'd get to $6. Seemed to be the best we can kind of hope for during some of those rally years, and for various reasons. $4. Is that where we were for D-Suite? 385. I mean, that was pretty bad. I would say now with the carryout that we have, we got to about $5, maybe in the low fives. That makes sense to me, just with having the carryout isn't a billion. It's more like 700, 800, could be 700, 800 million. So maybe the lows now are going to be the low fives for Chicago wheat, and those old highs of about $6 plus 20%, that's 720. You could have that range, that old range from 4 to 6 can now be kind of a 5 to 7. And really, the $4 is when we were just swimming in wheat on that billion carryout. Now that, we're burdensome, but we're not we're not swimming in wheat here. Plus, global major exporters tightest we've been since 2007. So at some point, if we get some demand come back to the United States, I still think we're running up higher here. Um, Russian wheat seems to be not budging. They've been about $217 per ton here for what seems like months. I don't think it's going any lower than that. If anything, it will go higher. You're starting to hear a little bit more about stronger cash prices in the Black Sea. That's interesting, and it makes sense. Harvest is done, so if the basis, wherever you are, whether it be Canada, the United States, Europe, Black Sea, once harvest is done, if demand is good, the basis should start strengthening, and we are starting to see that in Canada and in Europe and in Russia. We're at least hearing about in Russia. So I think wheat, close in Chicago, wheat above $6, like 605, would be bullish, and you think we start seeing the next leg up higher here. So I think wheat has the best bullish story at the moment because of the world exporter, because of the global world exporter stock situation. It is tight. Then I go to corn, would be my number two favorite market right now, because when I look at the balance sheet, you go 90, 91 million acres, which I really think is the most you can hope for next year. It's more likely to be 88 or 89. You usually don't see corn above 90 million acres unless everyone can pencil in profitable corn, which is not the case right now. In years where we're below cost production, it could be significantly below cost production. You get that 88 to 89 million acres, and honestly, 88 to 89 million acres and a trendline yield were drawn down on stocks. You get some weather issues, and it can just be minor weather issues where the yields are going to be in the high 170s, and boom, we're over $5. So more has to happen. Wheat's going to be tight globally in the export market by the end of the marketing year, uh, just by the math. But the corn will need a little help. It doesn't need that much help. So that's what I like there. Okay, so that's corn and wheat. Let's go to the oilseed side now. So we'll go soybeans and then we'll go canola. So I'm going to bring up my 10-year chart of continuous soybeans. So talk a little bit of oil too. Old trading range for soybeans when we had like a 550, 600 million carry out, 840. Maybe you had, I mean, one year we had that we dipped below $8 for a while, during the tariff wars and the swine flu. But for the most part, 10, 840, 840, if 860, you throw in 20%, that's a $10 bean market, which is kind of where we got down to. That's proved to be our bottom here. And then, the highs on a normal market for soybeans tended to be around $11, but you throw 20% on there, and now that's 13. So I'm thinking soybeans in the front month old crop is a $10 to $13 market, and then which would put new crop, maybe we can get run up to 12, before we start, kind of having targets up there. If I'm a buyer of beans, I can understand why you may be wanting to see how far prices can go, but we have the start of some pretty big weather issues in South America right now with the heat. Now, it doesn't take a whole lot to rain and weather adjustments to get things a little bit more back to normal in Brazil. But right now, that's not the case. Like, it is hot, it is dry. The market's got to respect it, and it's making bottoming action from August, and now it looks like we're having a bit of a reversal here on the charts in September. So I like ways of, and it's the same thing. I like collars. Selling puts around the lows of the month, buying calls. Um, Looking out to July. You can look out to March, which will get you through uh, basically any kind of South American weather issues. You can go to July, but I think there's some very interesting ways to go play the soybean market too. And I do think we're going to be a $10 to $13 market. The old 860 to $11 is, in my mind, 10 to 13 now, and that's purely just an adjustment for inflation. We'll see how it works out. And then, of course, you can always go below $10 if you're swimming in beans and have a 600 million carryout. We all know what that's like. Anyone who lived through you know, the tariff wars with China. But we also have all seen what it's like when beans get tight, right? Real tight. And the world's tight on beans. And you can see these, beans in the teens, beans in the high teens if you get the right conditions. So I just think that's where we are a $10 to $13 market, and we should trade that accordingly, especially as we're putting in harvest lows. And even if the harvest lows were last month, that's fine. Weather issues, the demand pickup can really get soybeans running here. So when it comes to the commodity markets, very difficult to pick a top or a bottom, which means you're either going to be early or you're going to be late, maybe a little bit late. That's fine. There's still plenty of room to run. You just got to accept it. You're either going to be early or going to be late on these things. All right, so let's get into that was soybeans. We go to soybean oil real quick, and then we're going to get into canola. So when I take a look at a 10-year monthly chart of soybean oil, before the whole renewable biodiesel thing, we were we would regularly have lows in soybean oil of around 20, somewhere between 20 and 30 cents would kind of be our annual lows, and the highs would be somewhere 35, 36, 37. Rarely got to 40. We need like some kind of drought to get to 40. Now, just like how ethanol completely changed the corn market, right? Where, I mean, man, going to $4 used to be just the bee's knees, and now it's going to be our low. When I take a look at bean oil, this 28 cent to 35 cent, 36 cent trading range it spent much of 2014 through 2019, and it's really shifted higher and has everything to do with renewable biodiesel. So, and if you take a look at a corn chart, before 2007, we traded between $2 and $4, and renewable fuels changed the corn market structurally so much that we went from basically a $2 to $4 market to a low 3 to mid 4 market with potential to go 5, 6, $7, even 8. Bean oil is the same. That high 20s to mid 30s market that I traded in for so long. I think we're now a 40 cent to, we're basically a 40 cent to 55 cent per pound in a normal market with the potential going to 60s, 70s, and 80s. It reminds me a lot of corn. We're starting to see that now. I think we're seeing the bottom being put into to bean oil uh, after the breakout of 2020, eventually getting into the 80s, coming back down into the high 30s, low 40s. Take a look at the chart for yourself, and if you can, if you take a look at the last NOPA crush, we drew down big on bean oil stocks. We're going to have more capacity in 2025. I don't think renewable biofuels and renewable biodiesels going away, and I think what we'll probably end up seeing here is bean oil having strength throughout the year. Now, a lot of it has to do with what happens with soybeans. If Brazil has a 169, then that's a little bit of a different story for million metric tons on their production, which the USDA was saying back in May. But with all this dryness, I just don't see. It's gonna be hard to have a 169. It's gonna be hard to have a 169 in Brazil with all this dryness and just even to the start of the season here. So I think we could potentially see a very long-term bottom in all the grain and oilseed markets here. Finally, I'm gonna switch on over to canola. Um, Here's the thing with canola. I'm gonna go back to a daily chart here. Let's go to RS. It's gonna go to a daily chart here. Here's the thing with canola. Recently, we've been as high as 680 on the board, price in Canadian per ton. I think we bottomed out in a big way at 540 on the board, and here we've kind of rallied all through September, which is interesting. So the canola probably only deserved to go to 560 per ton Canadian. Right now, European rapeseed is over $100 per ton more expensive. You got to think more export demand's coming to Canada. The only reason we probably went from 560 and made those lows in like the low 540s or high 530s is Canada, basically said they're going to be looking into an uh, anti-dumping probe and maybe ban some Canadian exports. Has everything to do with kind of what's going on with between Canada and China, and some electrical vehicles and tariffs on Chinese goods and stuff like that. And the kind of canola here is a little bit of is really a collateral damage, which would tells us China doesn't really need the canola. If they needed it, they wouldn't do this ban, or they can go buy it from someone else, and then traditional customers of Australia or Europe or whoever would come back to canola. Um, I would say what's interesting here is canola used to be a 450 to 550 market for the most part. It is probably now a 550 to 700 normal trading range market when it's supplied. And when I talked to farmers the past couple of weeks, a few themes have been popping up. In the Western prairies, canola has been disappointing. And then in the Midwest, and this has been relatively recent, but in the U.S. Midwest, soybean yields have been a little bit on the disappointing side, especially on the Eastern Corn Belt. Then you throw in the weather issues in Brazil, and you kind of got a little bit of an oil seed issue, right? Europe was a little bit light this year. That's why they're so much higher on the rapeseed than Canada is. And palm oil is going to be tight this year, which we've known for a while. But palm oil, canola, the canola rapeseed, and soybeans that makes up like 80% of the world's exportable vegetable oil markets. So even though the balance sheet in the United States looks big, and Brazil's going to be planting over 100 million acres. It's not. There are ways to get rallies in this market, whether it be soybeans and canola or corn and wheat. So, if I'm a farmer and I'm selling here, during harvest, I'm looking for re-ownership. I like buying calls. I like buying call spreads. I like buying call spreads and selling put spreads, buying the futures and then putting in maybe a short dated put for protection. But we're going to be coming into October here. It's traditionally bullish time of year, and a lot can happen. So if you're a buyer of commodities, a lot of the we are, a lot of buyers are locking in prices for this year and then going out and using the options market for 25 to set caps. And then for the farmer, for the spec trader and the farmer, I like getting long here, I like having long exposure. If you're the farmer, it's what allows you to sell into, right? By having your long exposure. You have those courage calls or courage collars to sell into. And then on the spec side, it's really just a directional trade. And I've been saying this for a while. I think we're putting in a multi-year low in the grains and oilseed markets here: corn, wheat, soybeans, and canola. We'll see if I'm right, but if the 20% inflation throughout the economy is real, which I don't know about you, but in all aspects of my life, it's certainly true. I think these are the new trading ranges. So we got to trade it accordingly. We got to market it accordingly. If you have any questions for me, let me know. You can check out my webinar series. The next one is going to be right after the election in November. It's only 6 weeks away. We're going to be going over the strategies that we like for the South American weather markets and where we think, it's the day after the election, so we'll do a big election review. Go to grainsandoilseeds.com. And if you want to, and again, all my contact information is in the show notes. Thanks for listening. Thanks for watching. Hope to talk to you all soon. And if you're harvesting, good luck out there.
This material is conveyed as a solicitation for entering into a derivatives transaction. This material has been prepared by a Daniels trading broker who provides research market commentary and trade recommendations as part of his or her solicitation for accounts and solicitation for trades. Daniels Trading, its principals, brokers, and employees may trade in derivatives for their own accounts or for the accounts of others. Due to various factors such as risk tolerance, margin requirements, trading objectives, short-term versus long-term strategies, technical versus fundamental market analysis, and other factors, such trading may result in the initiation or liquidation of positions that are different from or contrary to the opinions and recommendations contained therein. Past performance is not necessarily indicative of future performance. The risk of loss in trading futures contracts or commodity options can be substantial, and therefore investors should understand the risks involved in taking leveraged positions and must assume responsibility for the risks associated with such investments and for their results. You should carefully consider whether such trading is suitable for you in light of your circumstances and financial resources. You should read the risk disclosure accessed at www.danielstrading.com. Daniels Trading is not affiliated with, nor does it endorse any trading system, newsletter, or similar service. Daniels Trading does not guarantee or verify any performance claims made by such systems or services.